The tax reform legislation signed into law at the end of 2017 makes major changes to the U.S. tax code for individuals and businesses. This video focuses on changes for businesses. These changes take effect in tax year 2018, unless otherwise noted. The centerpiece of the law is a permanent reduction of the corporate income tax rate. The previous rates of 15%, 25%, 34%, and 35% have been replaced by a single flat corporate tax rate of 21%. In addition, the law permanently repeals the corporate alternative minimum tax. To reflect the lower rate, the law reduces the deduction that companies can take for dividends received from other U.S. companies, making more dividend income subject to taxation. The new law fundamentally changes the way multinational companies are taxed, with a shift away from taxation of worldwide income. Previous rules encouraged some U.S. multinational companies to keep profits earned by foreign subsidiaries outside the U.S. and outside the reach of the IRS. Under the new system, qualifying dividends from foreign subsidiaries are exempt from U.S. tax starting in 2018. But companies must pay a one-time U.S. tax on prior year foreign earnings that have accumulated in foreign subsidiaries since 1986. After making this one-time payment, companies can bring back foreign earnings to the United States without owing any additional tax. For tax years 2018 through 2025, a new deduction is available for individuals who receive business income from pass-through entities, such as partnerships, S-corporations, or sole proprietorships. The new deduction is generally equal to 20% of qualified business income. The deduction may be limited or eliminated altogether, depending in part on the amount of W-2 wages the company pays to employees and the specific industry. Regardless of these factors, a full deduction is available to single filers with a taxable income up to $157,500 and joint filers with an income up to $315,000, while a partial deduction may be available to single filers with a taxable income between $157,500 and $207,500, and joint filers with an income between $315,000 and $415,000. Generally, small businesses can elect to immediately expense the cost of qualifying property, rather than recover such costs over time through depreciation deductions. The new law expands the range of property eligible for expensing and roughly doubles the maximum amount that can be expensed in 2018, from $520,000 to $1 million. It also increases the threshold at which the maximum deduction begins to phase out from $2,070,000 to $2,500,000. Both amounts will be indexed for inflation in subsequent years. The new law extends and expands first-year bonus depreciation rules, but only through 2026. For qualifying property that is both acquired and placed into service after September 27, 2017, 100% of the property's adjusted basis can be deducted in the year the property is first placed into service. This amount will drop to 80% in 2023, 60% in 2024, 40% in 2025, and 20% in 2026, until bonus depreciation is eliminated completely in 2027. The provisions discussed here do not include all the tax changes in this complex legislation. If you have questions, contact your tax professional for more information. The tax reform legislation signed into law at the end of 2017 makes major changes to the U.S. tax code for